When we talk about economic warfare, the mind defaults to tariffs, sanctions, or trade blockades. We think of battles fought over steel, microchips, or oil. But the most powerful weapon ever deployed in the global economy is not a commodity, not a technology, and certainly not a missile. It is money. This is the untold story of how one nation, often dismissed in the West as a developing economy, executed a financial strategy so audacious, so brilliant, and so effective that it fundamentally reshaped global power and destroyed the industrial base of its rivals, not with armies, but with an artificially weak currency. The Western narrative insists on a simple truth. Strong nations have strong currencies, and weak nations have worthless money. China inverted this logic. They realized that in the global game of trade, weakness could be engineered into the ultimate, indispensable weapon. This is how China used currency devaluation to dominate global manufacturing, and why its strategy remains the most profound financial lesson of the last 50 years. To understand China's move, we must first rewind to the late 1970s and early 1980s. China had recently emerged from decades of self-imposed isolation. Its economy was agrarian, inefficient, and technologically lagging far behind the industrial powerhouses of the West and Japan. When Deng Xiaoping launched the Reform and Opening Up policy in 1978, the goal was simple: rapid, mass-scale industrialization. China needed to become the world's factory floor. But how does a nation starting from zero compete with established industrial giants in Germany, America, and the United Kingdom? Its labor was cheap, yes, but that was not enough. The initial factories were rudimentary, the quality inconsistent, and the global logistics network non-existent. To break into the world market, China needed to offer a price advantage so overwhelming that it would override all concerns about quality, distance, or geopolitical risk. The fastest, most elegant way to achieve this was to weaponize its own currency. In a traditional free market economy, if a country starts successfully exporting billions of dollars worth of goods, the constant inflow of foreign currency, dollars, naturally drives up the value of its domestic currency, the yuan or renminbi. This appreciation makes its goods more expensive abroad, eventually balancing trade. But China rejected this automatic balancing act. An appreciating yuan was a threat to its core objective: export dominance. The core strategy was born. They would artificially suppress the value of the yuan against the US dollar. A yuan that was kept weak meant that every Chinese-made product, from a steel beam to a pair of sneakers, looked irresistibly cheap on the global market. This wasn't an accident of economic weakness. It was a deliberate, long-term strategic choice. They traded short-term purchasing power for long-term global leverage. The execution of this strategy required central control and immense financial capacity. It was orchestrated primarily by the People's Bank of China, PBOC, China's central bank, which tightly controlled the exchange rate. Imagine the yuan, if left to float freely, would naturally trade at, say, 5 yuan per dollar. China decided that the market rate was too strong for their export goals, so the PBOC stepped in to keep the rate much weaker, often between 8 and 9 yuan per dollar for extended periods. How did they achieve this sustained suppression? Through constant, massive intervention in the foreign exchange markets. Every time Chinese companies earned dollars from selling their exports in America or Europe, they needed to convert those dollars back into yuan to pay local wages and expenses. The PBOC stepped into this process as the primary buyer. They would buy the incoming dollars, adding them to the nation's foreign reserves, and flood the domestic market with newly created yuan. This action had a dual effect. First, by constantly buying dollars and selling yuan, they maintained the high supply of yuan and high demand for dollars, thus keeping the yuan's exchange rate artificially low, exactly as planned. Second, this accumulation of foreign currency resulted in China building the largest treasury of US dollars and US debt in history. By 2014, these foreign exchange reserves peaked near $4 trillion. These reserves, financed by years of deliberately cheap labor and underpriced exports, were then recycled back into the global financial system, often by purchasing U.S. Treasury bonds. This recycling of dollars served a critical, unspoken geopolitical purpose. It kept the U.S. interest rates low, financing America's own colossal deficits and stimulating American consumer demand. The American consumer got cheap goods, the Chinese government got guaranteed long-term U.S. debt holdings and a continuously weak currency to fuel its export engine. It was a symbiotic relationship built on a fundamental economic betrayal. China's citizens paid the price of low domestic purchasing power, and American workers paid the price of lost jobs.
The impact on the global economy was immediate and devastating, particularly in the West. The cheap yuan made Chinese goods so aggressively priced that Western factories could not possibly compete. Industries that had been the backbone of the American and British middle classes for generations, textiles, steel, toys, electronics, and basic manufacturing, withered. Companies could not cut costs fast enough to match the artificially depressed prices of Chinese imports. The phenomenon became known colloquially as the Walmart effect. Consumers celebrated the bargain prices on store shelves, cheap TVs, cheap clothes, cheap everything, believing they were winning a victory of consumer convenience. But this convenience came at the cost of the industrial base. Western nations were rapidly deindustrializing. They were trading self-sufficiency and manufacturing jobs for consumer debt and imported goods. China's weak currency strategy achieved global market domination. By the early 2000s, China had transformed from a peripheral player into the indisputable factory floor of the world. It controlled entire supply chains, from the rare earth minerals required for magnets to the final assembly of advanced electronics. The West had outsourced its production, and in doing so, had surrendered indispensable leverage to Beijing. This was the lesson learned. A weak currency can be used as a strategic weapon to eliminate global competition and capture market share that would have been impossible to achieve through fair market dynamics alone.
Once China achieved industrial critical mass, the strategy evolved. The weak yuan was a necessary ladder to climb dominance, but once the summit was reached, the ladder could be kicked away. By the mid-2000s, Beijing allowed the yuan to begin a gradual appreciation. Why? Because the job was done. China no longer needed a dirt-cheap currency to attract manufacturing. It now possessed the factories, the infrastructure, the ports, the logistical expertise, and the skilled workforce. The momentum was irreversible. The focus shifted from simply producing cheap goods to dominating high-value, strategic industries. China began applying the same core principle, short-term sacrifice for long-term dominance, through other mechanisms, specifically through massive state subsidies. This is evident today in areas like solar panels. Aggressive subsidies allowed Chinese firms to flood the global market, crushing competitors in the US and Europe, and establishing near-monopoly control over the global solar supply chain. Electric vehicles, or EVs. Similarly, state backing has allowed Chinese EV makers to build scale and technological capacity rapidly, aiming to dominate the future of global transport. Steel and materials. Continuous state-supported production meant Chinese firms could undercut global rivals, leading to trade disputes and the collapse of Western steel industries. The weak yuan strategy successfully built the base, and the subsidy strategy is now building the next stage of global technological leadership. The initial currency manipulation was the foundation of this immense industrial power. The ultimate lesson of China's devaluation strategy goes beyond trade economics. It is a profound lesson in geopolitics and power. Money is not a neutral tool. It is a political declaration and a weapon. China demonstrated that currency exchange rates are not merely technical adjustments, they are the front lines of an ongoing silent war that determines who rules and who obeys. In the grand historical pattern of empire, money has always been the key instrument of control. Ancient Rome used debasement, mixing silver with cheap copper, to secretly fund endless legions and bureaucratic bloat, imposing a silent tax on its citizens. Imperial Spain flooded Europe with New World silver, causing the price revolution, which funded its wars but ultimately bankrupted its domestic economy. The United States secured its modern global dominance by linking the dollar to oil, the petrodollar system, and printing money, fiat currency, to fund its deficits and project power worldwide. China simply developed a different tool for the same game: strategic devaluation. Rome had legions, Britain had ships, China had the yuan. Today, the geopolitical impact is more tangible than ever. Control over global supply chains, built using the weak yuan, now gives China immense leverage. The West's reliance on China for essential manufactured goods, a reliance deliberately created by the low-cost currency strategy, has become a profound vulnerability in times of crisis or conflict.
History does not repeat, but its financial rhythms are hard to ignore. China's economic rise is a chilling masterclass in recognizing and exploiting global financial imbalances. It proved that a nation can willingly accept short-term financial discomfort, domestic inflation, and low purchasing power to achieve overwhelming long-term strategic superiority. The irony is that while American and European governments boast about a strong dollar or strong euro as a trophy, China leveraged a manipulated weakness into real industrial strength, while the West traded its productive base for cheap imported goods. The lesson for every investor, every citizen, and every nation is clear. Never mistake the number on the exchange board for the real story of power. Money is the ultimate weapon, and in the currency wars, you don't have to be a soldier to become a casualty. Those who understood this pattern early, those who built factories, infrastructure, and reserves, won the game. Those who chased cheap consumption lost their industries and their leverage. If you don't understand the mechanisms of currency manipulation and the financial architecture of global power, you will always be the one paying the invisible price.